Assalamu alaikum everyone. Today I'm going to discuss about chapter number 2, basics financial statement. As discussed in chapter 1, a financial statement is simply a declaration of what is believed to be true about an enterprise communicated in terms of monetary unit such as dollars. In this chapter, we introduce three primary financial statements. So, as I discussed earlier, financial statement are reports that show a business financial activities. And in this chapter, we introduce three primary financial statements: statement of financial position, referred to as the balance sheet, income statement, and statement of cash flow. The statement of financial position basically include assets, liabilities, and owner equity. Assets that represent what a company owns, including cash, account receivable, and inventory and equipment. Assets are economic resources that are owned by a business and are expected to benefit future operations. In most cases, the benefit to future operations comes in the form of positive cash flow, and positive cash flow may come directly as assets is converted into cash, and indirectly as the assets used in operating the business to create other assets that results in positive future cash flow. And one thing more, like assets' lives are different. Those that have less than 1 year are called current or short-term assets, and those that have more than 1 year life are called long or fixed assets. Now, let's talk about liabilities. Liabilities are basically financial obligations or debts that they represent negative future cash flows for the enterprise, and the person or organization to whom the debt is owed is called creditors. Last but not the least is owner equity. Owner equity basically represents owner claims on the assets of the business, and how owner equity increased. Uh, so the first point is investment of cash or other assets by owner and earning from profitable operations of the business, and decrease in the owner equity include payment of cash or transfer of other assets by owners and losses from unprofitable operation of the business. Now let's talk about the accounting equation. So the accounting equation includes assets is equal to liabilities plus owner equity. As I discussed earlier, assets are basically a company resources that are expected to provide future economic benefits, and liabilities are a company obligations to others arising from past transactions, and equity are basically the owner residual claims on the assets of the company. The income statement, a summary of a company's revenues and expense. Income statement is basically a summarization of company revenues and expense transactions for a period of time. Revenue. Revenue are increases in the company's assets from its profit directed activities, and they results in positive cash flow, and the income generated by a company from its primary operations. And expenses. are decreases in the company assets from its profit directed activities, and they results in negative cash flow. And the cost incurred by a company is generating its revenue, such as salaries, rents, and utilities. And net income basically include the difference between revenue and expenses, reflecting the profitability of a company. Statement of cash flow. Basically, cash flow is about tracking the movement of cash in and out of the enterprise. And the statement classifies the various cash flows in three categories. So the first category is the operating activity, second is the investing activity, and last but not the least is the financing activity. Let's talk about the operating activity. Operating activity are the cash flow from a company's core business activities, and cash flow from operating activities are the cash effects of revenues and expense transactions that are included in the income statement. And investing activities are the cash flows related to the purchase and sales of long-term assets. And financing activities, cash flow from financing activities are the cash effect of the owners investing in company and creditor loaning money to the company, and repayment of either or both. Now let's talk about the interrelationship among financial statements, and the second one is the statement of cash flow. Last but not the least is the statement of financial position. Let's start from the income statement. Income statement is a summarization of a company's revenue and expense transactions for a period of time. And revenues are increases in the company's transactions, and expense are decreases in the company assets. Now, statement of cash flow. Cash flow, as I told earlier, that cash flow is about like tracking cash in and out from the enterprise, and the cash flow classifies into three categories: operating activities, financing activities, and investing activities. And statement of financial positions are also known as snapshot statement and balance sheet, and that shows the liabilities, assets, and owner equity. Now, let's talk about like financial analysis. Data basically use financial data to make informed decisions. So the first one is the ratio analysis that evaluates financial performance by comparing different financial metrics, and trend analysis that track financial data over time to identify patterns and trends, and comparative analysis compare financial data of different companies or periods to gain insights. Let's talk about like forms of business organization that include sole proprietorship, partnership, and corporation. So let's begin from the sole proprietorship. Sole proprietorship is an unincorporated business owned by one person is called a sole
Oh,
proprietorship. Often
oh,
the owner also act as manager.
hello,
This
hello,
form of organization is common for small
hello,
retailers, stores, firms, services, business, and professional
hello.
law, medicine, and accounting. In fact, the sole proprietorship is the most common form of business organization in our economy. For an accounting viewpoint, a sole proprietorship is regarded as business entity separate from the other financial activity of its owner. And let's talk about the partnership. Partnership is an unincorporated business owned by two or more persons voluntarily acting as partners is called a partnership. Partnership like sole proprietorship are widely used for small businesses. In addition, some large professional practices, including CPA firms and law firms, are organized as a partnership. Let's talk about like corporation. Corporation is basically a type of business organization that is recognized under the law as an entity separate from its owner. Therefore, the owners of a company are not personally like liable for debts of the business. These owner can lose no more than the amount by they have invested in the business, and this concept is also known as limited liability. Now I'm going to talk about the summary of chapter 2. uh, so the first point is transactions are the foundation of accounting, and the double entry system ensures accuracy and balance. And debits and credits are key tools for recording transactions. Journal ledgers and trial balances help organize and verify data. Thank you for listening and see you next time.